Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know. First, IMF urges Bank of Japan to hike rates, pitting the central bank against a sliding yen and setting the stage for government intervention. We'll explore how this policy conflict could disrupt the massive yen carry trade and what it means for currency markets worldwide. Second, Amazon's 3.5% fuel surcharge signals a new war tax is hitting the US economy, accelerating the end of free shipping. So we'll discuss why this supply-side shock creates a stagflation dilemma for the Fed and what it means for interest rate policy. Third, UK parties' £40 billion plus spending promises ignore the fiscal credibility premium and risk another Trussonomics market meltdown. We'll analyse why these lavish fiscal promises are being made now and how they could destabilize UK government bonds and the pound. The International Monetary Fund just dropped a bombshell recommendation on the Bank of Japan, urging it to continue raising interest rates. What's truly remarkable, though, is they're pushing for this even as they acknowledge the significant new risks to the global economy from the Middle East war. So the thing is, Japan is in a particularly tight spot here. While it's the world's largest creditor nation with global influence, it's also a major energy importer, which creates a huge vulnerability. In 2023, Japan imported a significant portion of its crude oil from the Middle East. This means any disruption there directly threatens its economic stability, making the IMF's push for rate hikes right now incredibly risky. This puts Japan on a collision course with itself. The pressure is mounting from all sides. A conflict-induced spike in oil prices and a weak yen are driving up import costs and fueling inflation. It's crucial to remember that not all inflation is created equal. The Bank of Japan has been trying for years to generate good inflation driven by healthy wage growth. But what it's getting now is bad inflation, the kind imported from overseas. This is a policy nightmare. It forces the central bank to consider raising rates into a weakening economy, a dilemma the US and Europe faced in 2022, but it's even more acute for Japan after its long battle with deflation. The market is now betting heavily on the central bank's next move, pricing in a roughly 70% chance of another rate hike in April. Meanwhile, the yen itself is sliding towards the critical 160 per dollar level, a psychological line that has authorities on high alert. The yen's weakness stems largely from a strategy called the carry trade. Investors are borrowing money in Japanese yen, where interest rates are near zero, and then buying assets in countries like the US, where rates are much higher, around 5%. This massive interest rate difference allows them to profit from the gap. That constant selling of yen to buy dollars, that's the core market force Japan is up against. The IMF is commending Japan's strong economic resilience and says gradual rate hikes should continue as inflation moves toward the 2% target. But here's where it gets interesting. Nobody, not even the IMF or the Bank of Japan, is sure what a neutral interest rate for Japan even looks like anymore. After decades of zero rates and massive money printing, the old models are broken. This neutral rate is the theoretical level that keeps the economy stable. Without a clear target, the Bank of Japan is flying blind. If they tighten too much, they could kill the fragile economic recovery. If they don't tighten enough, they can't stop the yen slide, making their every move highly unpredictable. This isn't just an economic debate anymore. It's a high-stakes standoff. The Bank of Japan's own hawkish communication has signalled it's ready to act, further fueling market expectations. This has now forced the government's hand. In a direct warning to yen bears, Japan's Finance Minister Satsuki Katayama issued a strong warning. She stated that Japan stood ready to act, declaring, "We're ready to take all available means that are legally feasible, be it conventional or non-conventional." The statement signals a potential currency intervention that could send shockwaves through global markets. This sets up a fascinating potential conflict within Japan itself. The Ministry of Finance controls currency intervention, while the Bank of Japan controls interest rates. If the ministry intervenes to buy yen, but the Bank of Japan is too slow to raise rates, they could be working at cross purposes, testing the credibility of both institutions. Looking ahead, the situation could trigger a beggar thy neighbour effect. A persistently weak yen acts as a huge subsidy for Japanese exporters, making their cars and machinery cheaper on the global market. This directly increases competition for manufacturers in places like China and Germany. As China looks to export to navigate its own domestic slowdown, this intensified competition from Japan could escalate trade tensions. Going forward, the key focal points to watch are the Bank of Japan's next policy meeting in April, and of course, the yen's exchange rate. If it crosses that 160 mark, the chances of direct government intervention will become extremely high. We were just talking about Japan grappling with imported inflation, and now a similar story is unfolding in the US, but with a different trigger. Amazon just slapped a 3.5% fuel surcharge on its sellers. United Airlines and JetBlue are hiking baggage fees, and the United States Postal Service has asked for an 8% surcharge. This isn't just about the price at the pump. It's a war tax from the US, Iran conflict cascading across the entire American economy. This is that stagflationary war tax we've discussed finally showing up on your receipt. We're seeing corporate giants pass the bill to their partners, while at the same time, small businesses are getting absolutely crushed. Take College Hunks Hauling Junk, a moving company with a 2,000 truck fleet. Their fuel costs have doubled, eating up to 10% of total revenue. The co-founder calls it a catch-22. Either raise prices and lose customers, or absorb costs and destroy profit margins. This is that dynamic playing out in real time. And this isn't just an anecdote. The data paints a stark picture of a bifurcated economy where large corporations have the power to pass on costs and smaller firms don't. A critical indicator to watch here is the NFIB Small Business Optimism Index, which has fallen for 3 straight months. The fallout is significant because when small businesses get squeezed like this, it often signals a coming slowdown in job creation and a potential wave of business failures. And if you think this is just about shipping, think again. One expert warns this isn't a single price shock, saying this is headed towards sustained, compounding cost pressure across every industry that touches fuel, which is effectively every industry. Another strategist says we are witnessing the end of the fast and free shipping era as a default expectation. Actually, this shift was already in motion. Even before this conflict, the economics of free shipping were starting to crumble. For instance, Amazon's fulfillment expenses soared to nearly $100 billion last year. This new fuel shock isn't creating the problem. It's just accelerating an unsustainable trend and forcing a fundamental change in e-commerce. So, can the government step in? Unlikely. A chief investment officer warns policy is likely not riding to the rescue like it did during the COVID era. Even the Federal Reserve is caught in a bind, hesitant to stimulate the economy and risk pushing inflation higher. After all, this is a supply side problem. Interest rates can't pump more diesel. This is where the situation takes a more complex turn for the Fed, putting it on a geopolitical tightrope. Its standard playbook is to look through temporary energy shocks, but what if this isn't temporary? If the conflict persists, we could see second round effects, higher energy costs lead to higher shipping costs, which then lead to demands for higher wages, embedding inflation across the economy. This could force the Fed into a terrible choice: raise interest rates into a slowing economy, or do nothing and risk losing control of inflation, echoing the painful stagflation of the 1970s. This conflict is forcing a massive reset. For consumers, the pain at the pump is just the beginning. It's also triggering what some economists call a trade-down recession, where people still spend, but they spend differently. Believe it or not, this means headline spending numbers might look okay, but underneath, sectors that rely on discretionary spending could face a quiet collapse. Interestingly enough, there's also a global angle. While US and European companies pay a premium, China may be able to secure discounted oil from Iran, much like the dynamic seen with Russian oil. For businesses, this is not a temporary problem. One industry president says companies relying purely on surcharges are on borrowed time, with probably 2 to 3 quarters before they face a reckoning. And as the IEA warned, the longer this drags on, the worse the economic damage, meaning that runway can shrink fast. So, while the US government seems hesitant to step in on the inflation front, politicians in the UK are doing the exact opposite, making lavish promises that could create a whole new kind of economic crisis. The ghost of a £45 billion disaster is haunting the UK as the memory of Trussonomics, a plan whose unfunded tax cuts sent markets into a tailspin, forms the backdrop for an extraordinary bidding war. What really brought this to a head during the Trussonomics crisis was the creation of a fiscal credibility premium. Essentially, when global investors think a government spending is irresponsible, they demand higher interest rates to lend that country money. We can see this real measurable cost by comparing the yield on UK government bonds to safer German bonds. During that crisis, The gap widened dramatically, a clear warning sign that constrains any future government. And the scale of these new promises is immense. Reform UK is embracing the Trussonomics playbook, pledging to raise the income tax threshold at a cost of more than £40 billion a year. The Conservatives are campaigning on a promise to slash the welfare bill by £23 billion, with one minister declaring the culture of something for nothing must end now. But that's not the whole picture. The Green Party has previously proposed a plan to increase taxes by over £170 billion a year, including a £90 billion annual carbon tax, all to fund a massive boost in public spending. However, if you zoom out, you'll see a hidden consequence at play, a phenomenon experts call austerity by stealth. Here's how it works. Because major areas like healthcare are politically protected, any funding gaps have to be filled by squeezing so-called unprotected departments. The Institute for Fiscal Studies has shown this is already happening. While overall spending has risen, departments like housing and the Foreign Office have faced real terms budget cuts of over 20%. This is the stark reality behind the headline-grabbing promises. The situation presents a fascinating duality. On one side, you have parties offering magic bullet solutions, betting that voters want a dramatic escape from years of slow growth. On the other side stands the Labor Party, which appears to be resisting these extravagant promises, instead grappling with a major hole in the public finances. Labor's big gamble is a kind of economic catch-22. Their strategy is to use targeted investment to generate future growth, which would then pay for public services. But this faces a critical timing challenge. With UK labour, productivity actually declining by 0.6% last quarter, if that growth doesn't materialise quickly enough, the party will be forced to choose between breaking its own fiscal rules, risking another market panic, or implementing the very austerity it opposes. The battle lines are drawn not just between parties, but between two fundamentally different economic philosophies. As elections approach, the central question is whether voters will be drawn to audacious, high-risk initiatives, or if the memory of a recent economic catastrophe will lead them to favour a more cautious approach in an increasingly uncertain world.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.